we're in a conversation with Raina Michael Preiss of Taurus Wealth Advisors. Raina, good morning, and thanks so much for joining in. What are you making of, one, the possibility of a rate cut to the tune of 50 basis points, and secondly, how would you then evaluate, the way markets can shape up?
Yeah, look, I mean, I think Chairman Powell is in a rather difficult situation, because if you think about it, it's almost like the proverbial you're doomed if you do and doomed if you don't. Because if you think about it, why would you cut rates aggressively when the stock market in the United States is close a couple of percentage points away from all-time record highs? And if the argument would be a preemptive cut, that potentially the trade war could escalate further and the economy is potentially weakening even more strongly and accelerating to the downside, then maybe that interest rate cut that everybody was bidding up in the stock market might actually turn around to what is often referred to as buy the rumor, sell the news. Because what does the Fed know that the average investor doesn't know? Is the economy much weaker than most people would currently believe? So I think it's a very tricky situation in the markets, and maybe there's too much expectation built into this interest rate decision. But the consensus increasingly seems to see that we might actually be on hold tonight, but in July we might potentially see a cut.
Hi, Raina. In fact, that's the expectation from market side, that this policy, they could just clear the way for a July rate cut by downgrading their economic forecast and also tweaking the language in their statement, because we've seen a rate hike actually from Federal Reserve in the month of December. So it's central banks, Raina, around the world have been now on easing spree. In fact, yesterday, Mario Draghi of ECB also suggested that they could increase the time of stimulus in order to, support the economy. Do you then foresee the risk off environment in global markets?
Yeah, look, I mean, in my mind, the biggest risk is that the so-called politicizing monetary policy. I mean, last night, Mr. Trump's comments with regards to the ECB and the ECB cutting, basically implying further stimulus, unfairly leading to euro weakness, which is inconveniencing the United States economy and U.S. exporters. I think it's very dangerous if we go down that road, because by definition, by statute, central banks should never really be too politicized, because then again we're going down a very slippery road, and that's really the danger that I see. I think the other question here is, everybody knows about the China trade tensions, but what if these trade tensions increasingly move on toward Europe? That potentially would be net negative for risk assets. So I think it's a very delicate moment, and I think it's important to sort of step back and also look at the message of the bond market, because the bond market, government bonds in particular, seem to imply that there are concerns about economic growth, and that just hopes of interest rates cuts don't necessarily mean that it's smooth sailing from here.
Raina, so how are you anticipating the movement of funds across and between developed economies as against emerging economies now?
Yeah, look, I think we might increasingly I think anybody who just thought that the U.S.-China trade war is about trade might actually increasingly realize these are a clash of civilizations, and increasingly there's no easy fix to a very complicated issue. I would say that, for example, certain countries like India in particular, and to a lesser extent even Germany and France, might actually benefit if the U.S. If the U.S. would hike tariffs further on the Chinese, and especially the Hong Kong question would be very important, because if Hong Kong would change this sort of autonomous status as far as the U.S. is concerned, that potentially could lead to major rebalancing around the world. So I think that other markets might actually benefit out of this. And India could be one, Vietnam could be one, but I think also certain European countries in this net new trade war world might actually benefit. But in the meantime, I think for the second half of the year, we might actually see increased volatility. That one-way straight up since the December lows, most probably I think now will be met with sort of more volatility, while the market is trying to figure out whether the bond market signals are correct or the equity market signals are correct. Because as you know, they send a very contradictory message to investors.
Raina, in light of central banks around the world being on easing mode, would you then expect more money flowing into emerging markets? Because if there's no rate cut coming from this policy tonight, there could be a rate cut coming in July. At least that's what the majority of the economists have been factoring in.
Correct, and yes, I mean, if you think about it, also, I think the key question, also, I mean, all of the discussion about the trade wars is also fundamentally a currency question. So, should the dollar weaken, this potentially could be good for emerging markets. So again, I mean, that's basically, I think, also why I think Mr. Trump got so upset yesterday when the euro suddenly weakened, because I think from their perspective, to bring jobs back to America and have more American exports, I think the Trump administration might actually prefer a weaker dollar. So from that perspective, that would be net positive for emerging markets. But don't forget, it's ultimately about growth. Which countries in the world have strong, fundamentally based economic situations and countries where you would like to invest for the long run? And that is increasingly still in emerging markets, because as the ECB told us yesterday again, that even after many stimulus effects and so much QE in Europe in particular, the economy is not really moving. So I think more and more investors will look at emerging markets, because that's where the growth is.
Reina, the other aspect here is, and this is perhaps not to do with the FOMC meet today, but well, we are getting confusing signals from President Donald Trump, and especially when it comes to tariffs with China. And of course, in the latest, we've had a perceived positive development. But how are you seeing these things, and what is your reading into these issues?
Look, I mean, my reading is that the biggest issue in any context, trust is the most important currency, and the more often you change your views or positions, whether, I mean, the Mexico example is a good example, trust can be broken easily, and then increasingly it will be more difficult to come to better outcomes. Because if people or investors in particular don't trust any of these statements anymore, then the signaling effect will be broken, and that's the real danger that I see, that you do these announcements too carelessly, too often. It might actually lead to nobody listening when they should be listening. And I think that's the danger that I see. That's why I also expect higher volatility in the second half of this year.
Reina, before we let you go, on India, the focus of both the central bank and the government has been on growth. In fact, India has been ahead of the curve. We've already had 3 rate cuts coming by, but growth has been a major concern. Recently, Fitch downgraded FY20 growth targets to about 6.6 from 6.8. So can this be the biggest hurdle going ahead for India in terms of more money flowing into our markets?
Most probably, yes. And I think, again, I mean, if you remember when Mr. Modi was elected first time round, it was on this belief that we see a lot of reforms, and global investors love that and bid up Indian assets. And in terms of price earnings ratio, Indian equities are rather expensive or elevated compared to other Asian markets. So I think what investors would like to see, further commitment to sort of further deliberalize the Indian economy and have more reforms. But otherwise, look, the long-term investment case is very compelling. And especially if we go into a sort of more tripolar world where increasingly the Chinese work with the Russians and the US is taken on the European Union, India could be one large country that would actually benefit out of this confusion and potentially changes in trade flows. So I think India could long-term be a real winner out of this. Also because I think many people would have to reevaluate their China investment strategy if, for instance, the tariffs would go up, if there should be any failure in this G27 meeting. And India would be one market where potentially we can see flows out of China, potentially into India, where people on an asset allocation decision basis increasingly think about increasing allocation to India at the expense of China.